Good evening, everyone, and welcome to this video tutorial. Today we're going to talk about preparing management accounting information for managerial decision making. And specifically, we're going to prepare some forecasting information to assist management decision. You will see the specifics about what we want to do today by looking at the question that we want to solve. So let me take you straight to the question. We'll read the question together, look at the question requirements, and it is just about what I have just described. Okay. The following data, that's the data in the table, shows the quarterly promotional expenditure and the corresponding sales volume for floor mat company for the past 4 years. So we can all see the data. So we have the years and the quarters within the years. So this is how the system of the numbers are speaking. The year dot quarter, it means that 1.1 is year 1 quarter 1, 1.2 year 1 quarter 2. Each year has 4 quarters. So for year 1 we have the 4 quarters, year 2 the 4 quarters, year 3 4 quarters, year 4 4 quarters. And we have the corresponding data for sales volume and promotional expenditure. So let's go ahead with a question. As a management accounting trainee, just as you are tasked to prepare forecast information using the techniques of high-low method for managerial decision. You are specifically required to identify which of the two variables, either sales volume or promotional expenditure, is the independent variable and which one of them is the dependent variable. After that, you are required to determine the cost volume equation linking the two variables. And finally, you are required to do this. Assuming the value of the independent variable for year 5 quarter 1 is 300 Ghana cedis, predict the value of the dependent variable for the same period. Okay, so that's what we are supposed to do, and then we solve the problem. Okay, so let's tackle the question. First of all, we are supposed to identify which of the two variables are, which of them is the dependent variable and which is the independent variable. And from discussions we've held so far, I think that should be easier to do. We established the criteria for identifying which two variables, at any point in time, which of the two variables is the dependent variable and which is the independent variable. We said that the dependent variable is driven, the values of the dependent variable are driven by the values of the independent variable. The independent variable is also referred to as the predictor variable. In other words, the values of the dependent variable are predicted by the values of the independent variable. If you look at this question that is before us, this is a normal business situation, so don't think too theoretical. In business, we do sales promotion by incurring promotional expenditure with the aim of boosting sales volume. So it is clear that in this particular situation, the sales volume is the dependent variable. In other words, the promotional expenditure is driving or is going to predict the values of the sales volume. The values that will record of sales volume will be determined from how much promotional activities we do, and therefore how much promotional expenditure we incur. That's how you do the determination. Sales volume is the dependent variable. Promotional expenditure is the independent variable. Alright. Before we go to the next level of the question, it is, even though it's not part of the requirement of the question, it is always a good idea that you try to get a sense of how these two variables are correlated. In business, we normally make the simplistic assumption that variables are related in a linear fashion. So in this case, we are assuming that sales volume and promotional expenditure are related. Of course, they are. Promotional expenditure will drive sales volume. That's how they are related. But what is the strength of the relationship that exists between them? Right? So we may want to get, without going into details, get a sense of what it is. So if I copy this data of sales volume, promotional expenditure as the two variables, and paste them in Excel as we have here, then we can get a sense of the correlation between them in a graph. So we can do a scatter. So when I block the range and come to do scatter, okay, this scatter will give us a pictorial sense of how the two variables relate to themselves and how the power of relation looks like. So we can all see from how the dots are moving that the two variables are somehow strongly correlated. It takes the shape of the supply curve. So they are correlated, or they are related positively. As one moves up, the other is also moving up. So this is the general picture. And we can even add a trend line to get a sense of a line that depicts the perfect relationship between them. So this is a trend line. So the trend line, like I said earlier, is positively sloped, like a supply curve. It means that as promotional expenditure is increasing, so we expect sales volume to also follow suit. Okay, so that's good. Now we know which of the two variables is the independent variable and which is the dependent variable. We were able to establish that the sales volume is the dependent variable, and traditionally the dependent variable labeled as Y, sales volume, is put on the vertical axis, and this is the promotional expense or expenditure. Alright, so I'm just using this same graph. I think it will be a good thing to enlarge the graph. Sorry about that. Right. Okay. So nobody should have a problem with, this kind of demonstration. Dependent variable is sales volume. The independent variable is promotional expenditure. And this is the strength of relationship between the two. Now let's go to the next question. The next requirement of the question. Determine the cost volume equation linking the two variables. In fact, this is a compressed question which requires you to do a number of things. But before then, let's look at this. We have established in class that the general form of a linear equation linking two variables is of the form y is equal to a plus bx. This is the generic form. This y is the dependent variable. This a is the fixed component of the dependent variable. This b let me talk about the whole of the bx. This bx is the variable component of the dependent variable. Sorry for my handwriting. Right, so when we superimpose the variables in our question to this framework, we can understand that this one is the y represents our total sales volume. That is the dependent variable. The A represents fixed volume of sales. That is the volume of sales that does not have any dependence on promotional activities or promotional expenditure. And BX represents the total variable sales volume. Okay, so if we want to rewrite, kind of make it more tailored, this is too generic, this is how the mathematicians like writing it. If you want to make it a little bit business-like, we can write the general linear model as sales volume, which is total sales volume, is equal to some fixed amount of sales volume which which has no link with the promotional activity. Still A, let's still use the A, plus the portion of the total sales volume that is driven exclusively by promotional activities. B, in this case, let's use E for expenditure, promotional expenditure. So we can tailor our cost volume formula equation in this form. Make it more business-like. Alright. So now our responsibility is to determine this. Determine this. And once we have the values for this, we can write our general model. And the question says we should use the techniques of high-low method. After this, I'll give you the overview of regression. Of course, it's not too difficult once you understand the main requirements here. I think the main things are how you identify which variable is the dependent variable and which is the independent variable, and how things flow from that determination. The rest, whether it is about regression or it's about high-low method, is not really the issue. It's about just applying the principles. Okay, so how do we determine B? We always determine the B first. This B is variable sales volume per CD. So variable sales per unit of expenditure, and the unit of expenditure will be 1 CD. So per CD or per 1 CD, per 1 CD of expenditure. That is B. So B is going to measure. We are saying by this expression that the values of sales volume are driven by this expression, or is dependent on this expression. The values of total sales volume is determined by knowing some fixed volume of sales which pays no respect to promotional expenditure, plus a portion of sales volume that depends exclusively on promotional expenditure. That's what we are speaking by this expression. Right? So once we are able to determine B, of course B is also speaking that if you know the level of the expenditure, this B is saying that, okay, I am going to help you to know how much total sales volume will change if 1 unit of the expenditure is incurred. In other words, B is measuring the magnitude of response from the total sales volume as a result of 1 unit change, 1 CD change in the promotional expenditure. If you're able to determine that, then we can know that at any given level of expenditure, we can know the total sales volume that depends exclusively on expenditure. That is total variable sales volume. So let's according to the high-low method, the determination of B, which is also, so that is the, in this case, variable sales volume per unit. Okay, so you should understand, I have to use some shortcuts. Variable sales units. Okay, let's make it V. Variable sales volume per unit into brackets B is equal to, and before I write this formula, I want us to take some lessons from the graph that we have drawn. I think it's also on the Excel, yeah. So let me go back. Okay, so you saw this, and we said The dependent variable is on the y-axis, the independent variable is on the x-axis. So this is sales volume, in other words, total sales volume. Total sales volume, and this is total promotional expenditure. The B is measured by the gradient of this line. This line is just plotting the points on sales volume and promotional expenditure. So this is the trend line. So when you do this, this is measuring change in sales volume, and this is measuring change in promotional expenditure. B is equal to the gradient of this line, which means B is equal to the change in SV divided by the change in E. That is B. So B, as we wanted to measure, which is the variable sales volume per unit of expenditure, is going to be SV2 if you like. So let's use those symbols. SV2 minus SV1, that's the change in the sales volume, divided by E2 minus E1. So this is the corresponding promotional expenditures. So that is the measurement of B. Please let me pause a little bit to draw your attention to something very critical. The first examples that we solved in class, you remember it was between units of production and total cost. In those examples, unit of production was the predictor variable, in other words, the independent variable, and total cost was the dependent variable, because it is clearly understandable that when we produce more, the more we incur production cost. So total production cost is driven by units of production. So the dependent variable was total costs of production, and the independent variable was units of production. In this particular instance, between sales volume and promotional expenditure, it is a reverse between volume and expense. Here, volume of sales is rather the dependent variable. In the first example, volume of units of production was the independent variable. So that's where you need to be critical about your determination of dependent, independent variable and how the calculations flow from there. Otherwise, you can get everything wrong. So in this particular case where we have this sales volume, the volume rather being the dependent variable on the y-axis, and the expenditure, the cost, being the independent variable on the x-axis, then the B, the measurement of the B, is change in y over change in x. So it's going to be, sales volume 2 minus sales volume 1, all divided by expenditure 2 minus expenditure 1. It follows simply from mathematics. I don't think this should be a problem. Okay, so that's it. We were trying to do this. That's what took me to that lengthy discussion. So variable sales volume per unit, represented by B, is equal to change in sales volume divided by change in promotional expenditure, which is, like I was trying to illustrate above, SV2 minus SV1 divided by expenditure 2 minus expenditure 1. That measures the variable sales volume per unit of expenditure, per CD of promotional expenditure. Right? So let's just slot in the values. So we just have to identify or determine highest SV2 or highest sales volume. If you go back to the question, but I copied the same question in the spreadsheet, so we can go back here. And I think I need to zoom. That's what I'm talking about. Sorry about that. Okay, so zoom in. Alright, so this is the data. Don't worry, I can scroll for you to see. So this is the data. Let's go back to what we're trying to do. The biggest volume or the biggest activity or the highest SV2 is, let's go through the table here, or maybe let me refer to this one. This is better. Okay, so when we look at the volume side, which is the biggest volume, then we trace it to the cost. So we can have 210, 1000, 1000, there's 2800 here, which is bigger than this two. Let's see if there's another 22, and there's 600. So I think this is the biggest here. Okay, so the biggest volume, which is SV2, is 2800. Let me just write it. So SV2 is 2800 minus SV1. Let's go back to the question. SV1, I think that is 600. Yeah, 600 sales volume minus 600. Minus 600, all divided by the corresponding costs. The corresponding cost to the 2800 volume, 2800 is 250. Okay, so just let's make it 260. It's 260. It doesn't really matter, you can maintain it at 250. So let's say 260 minus the cost corresponding to the lowest volume. The cost corresponding to the lowest volume is 100. So this is 100. Alright, so we are on our path towards determining the variable cost per unit. Alright. So variable cost per unit is 2800 minus 600. That will give us 200 divided by 260 minus 100. That will give us 160 some, I think. Yeah, 160. So let's do that calculation. 200 divided by 160. What do you get? That gives us 13.7 0.75. So variable sales volume per unit of promotional expense is equal to 13.75 cities. This means that every city of promotional expenditure that we incur, it will result in, okay, I don't think this will be cities, we're talking about sales volume. It will result in 13.75 units of the product being purchased. So we can make it more reasonable. Since for example, if you are selling books, you cannot have a fraction of the book. You cannot say, someone cannot come and say, I'm buying one full book plus half of the other. So let's say this is approximately 14 units. So it means that every 1 cedi promotional expenditure incurred 14 units of the product. It will drive 14 units of the product to be purchased. That's what it is speaking. Approximately 14 units of the product to be purchased. Okay. Or if you want to use what is the 13.75 units of the product to be purchased. And whether you use 14 or 13.75, I think each one of them is okay. So we have determined the variable sales volume per unit of expenditure, which can help us to determine the total variable sales volume at any given level of expenditure. So from what we are doing, we have determined 2 levels of expenditure, E2 and E1. And like we discussed in class, we have the option to stick with one, only that we have to be consistent. But you can be guided by certain conventions and concepts we use in accounting. From the prudence concepts, we normally go like, if it is about revenue, think like revenue maybe lower rather than revenue maybe more, right? And you do the reverse for expenditure. So since this is about revenue, I mean sales volume determines the sales revenue. Then we may want to actually use the lowest expenditure level, because the expenditure level drives the sales volume. We don't want to have a bigger sales volume. If we use E2, it will give a bigger sales volume. And since we want to be a little bit conservative, we may want to deal with a lower level of sales volume. After all, if we plan with lower levels of sales volume and it happens that sales volume is bigger, that's an advantage. Okay, so based on that logic, I will choose E1. But if you choose E2, no problem. Just that you have to be consistent. If I choose E1, E1 is 100 Ghana cedis. So it means that our total variable sales volume, will be equal to variable sales volume per unit of expenditure 14 times the total expenditure 100, which will give us 1400. 14, sorry, let me write it again. 1400. So from what we are doing, it means at promotional expenditure level of 100 Ghana cedis, the part of our sales volume that will depend on that 100 Ghana cedis will be 1,400. if we had used the bigger expenditure, which would have been 260, that would have been total variable sales volume is equal to 14 times, let me look at the value again, 260, and that would have given us 3,640. Alright. You can choose to deal with any one of them. Now let's go back. So this is either your total variable sales volume, or this one, depending on which level of expenditure you choose. So if you choose this one, the bigger one, then we can estimate our total fixed sales volume from there. Total fixed sales volume is equal to total sales volume minus total variable sales volume. This is our total variable sales volume at expenditure 260. So let's go and look at the total sales volume at expenditure 260. It is 2,800. It is 2,800. That's the total sales volume there. So if you do the computation, you will realize that total fixed sales volume is equal to 2,800 minus our total variable sales volume of 3,640. This is yielding some weird values. So this will give us total fixed volume of sales as a negative figure. Negative figure of 840. But even though it makes mathematical sense, I think in real life nobody does negative sales. So what it's actually speaking is that without promotional expenditure, we don't make any sales. And apart from not making any sales, it's like customers are even angry. I'm just trying to interpret the negative over there. If it were a positive figure, that would have represented the portion of sales in this case which you generate even without promotional expenditure. So this might be because it's hypothetical data, is an extreme situation where you have negative sales. Okay, so even though for mathematics purposes we can complete the model by saying that our total sales volume is equal to the fixed, which is negative 840, plus the variable, which was 14, expenditure. Since this one does not make any practical sense, and it's only trying to say that if you don't advertise, we don't make sales, we don't have negative sales, you can practically write it as total sales volume is equal to 14 E. Yeah, so from this particular question, this is what the solution will be like. Well, mathematically, if you write this is not wrong. But practically, this is how it will be, because we don't have anything like negative sales. All right. So once we have our cost volume equation determined, then we can just follow or just use that one to determine to do forecasting to determine the total sales volume that will be generated at any level of promotional expenditure. And that's the last bit of the question. The last bit of the question, that assuming the independent variable has a value of 300. The independent variable here is the promotional expenditure. Predicts the value of the dependent variable. So SB, which is the dependent variable that we are searching for, is equal to, if you are being mathematics centric, then it will be 840, negative 840 actually, plus 14, and it said the level of expenditure is 300. So SV is equal to negative 840. 14 times 300 will give us, so punch your calculator and give me the answers. Okay, that will be 4,200. So then SV, total sales volume, will be equal to, so this should be plus, it should be equal to 4,200 minus 840, and that will give us 3,362, which means that at promotional expenditure of 300 Ghana cedis, we should expect from the model, that sales volume that will be generated will be 3,360, and this is in the following parts: negative 840 fixed and variable 14 times 300. Right. So I hope it goes well. In case you want to use the practical model that we derived, in which case we said we don't have negative sales volume, so the model will reduce to SB is equal to 14E. In that case, then your SV will be equal to 14 times 300. 14 times 300 is equal to, just point the calculator and tell me please, 14,300. 4,200. And this one is reduced to 0. So this will be our level of sales volume if we advertise at a cost of 300. Right. So the basic or the underpinning understanding of the concept is what matters most. It's not really about the mathematical manipulation of the figures. Right. I hope all of you are okay. So this same question, you may be required, or you could be required to approach it with regression techniques. And we all know the regression technique, right? We know the formula that regression uses to determine the value of B. So use just that formula. And that formula will require that we set up a table to calculate. We have the dependent variable is Y, so this is Y. This will be Y, sorry. This will be Y. And this will be X, the independent variable. So we'll have X, we'll have Y, we'll have the product of X and Y, and we'll have X squared. We have to calculate all these values and find the sums of each of them. And then we can use the regression formula. B is equal to n sigma xy minus sigma x sigma y all over n sigma x squared minus sigma x all squared. Use this formula to determine the value of B. Alright, it's because of the nature of this formula that we need to set up a table to calculate xy, calculate x squared. We already have the x and y. then we can have all the values that fit this formula for us to determine the value of b. Once the value of b is determined, then we go ahead to determine the value of a. And we all know how the value of a is determined. The value of a is determined, using regression techniques, by the formula a is equal to sigma y over n minus b sigma x over n. Alright, so you set up a table. Once you have already set up a table to do that, all of these things are captured. Then you determine the values of a and b from those values you have actually computed from your table. Right. So I think this tutorial should be of help to you in approaching your solution of questions in this area. If you have any other questions, you can direct your questions to my mail or to to the Google Classroom platform, or you can call me if you wish. Alright. Yeah. But one important thing to do is that there will be a series of such videos to update you or to equip you with some knowledge ahead of any exam that we have to do. So it will be a good thing for you to subscribe to the channel by clicking the subscribe button below the video. I'm also going to attach the question, the file that contains the question, to the video, so you can find it below the video in case you want to actually download the questions and practice with them. Thank you very much for your attention. I hope this video serves you some use. Thank you.